Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into TransDigm Group, TDG. And this is a company that has, well, it's managed to be one of the highest performing stocks over the last decade. I mean, we're talking about generating superior returns even against titans like Apple. The central conflict here is just so sharp. TransDigm's entity is this private equity machine operating in the public markets, and it's built a nearly impenetrable monopoly moat with its sole source proprietary parts. But, and this is a big but, that whole model is now under some serious fire from a regulatory tail risk. We're talking price gouging allegations and a massive $30 billion debt load that leaves absolutely no room for error.
That is the perfect way to frame it. It's this inherent tension in the company. You've got this, brilliant financial engineering on one side, and on the other, you have critical government defense and commercial aviation needs. When you really look at the DNA of TransDigm, you have to go back to the founders. Nick Howley and Doug Peacock both were former McKinsey consultants, and they started the company back in the early 90s. And you have to understand, they weren't trying to start a traditional aerospace company. Not at all. They were starting a financial model, one that was just optimized for, high cash flow and maximum leverage.
And that background, that McKinsey DNA, that really matters, doesn't it?
Yeah.
Because they just deliberately avoided the standard playbook for aerospace. The big airframers, they're tier one suppliers.
Yeah.
They operate on thin margins and just massive volume.
Right.
They sell the wings, they sell the engines. TDG sells these tiny specialized parts inside the engine.
Exactly. Howley and Peacock, they actively steered clear of that whole high-volume, thin-margin production game. Instead, their entire strategy, and they've been so consistent with this, was to go out and acquire small, niche businesses. And these weren't just any small businesses. They were companies that completely dominated a specific, highly critical, certified component of an aircraft. A component that might be tiny, but if it failed, it would be catastrophic. And once they acquire them, they treat these businesses like assets in a perpetually rolling private equity fund. The focus is just laser-like on maximizing cash flow, operational efficiency, and of course maximizing shareholder returns by leveraging up the balance sheet.
Okay, let's get a little more granular on what they actually sell.
Yeah.
Because when you say aerospace components, that sounds so generic. But their specialty is this deep integration. It's almost like operational invisibility.
That invisibility is absolutely key to their pricing power. We are talking about hundreds of thousands of individual SKUs, stock-keeping units of these highly engineered proprietary parts. Their product portfolio, it spans these really complex, indispensable systems. You probably don't know the name of the company that makes the engineered latching devices for the cargo bay door, or the specialized fluid controls that manage hydraulic flow. But TransDigm probably owns them. The parts they supply are just critical to airworthiness.
So we're talking about things that are core to flight safety, navigation, just basic operations. The sources, they highlight products like engineered latching and locking devices, specialized cockpit displays, high-pressure fluid controls, even cockpit security systems and specialized thermal insulation. They are just deep, deep inside the defense and commercial supply chains.
Yes, and these are parts where reliability, the lack of failure, is just completely non-negotiable, and it goes beyond physical parts. They also provide things like complex flight testing, wind tunnel services, specialized jet engine testing equipment. The focus is just relentlessly on these unique engineered products, the kind that airframe OEMs like Boeing and Airbus need, and also the airlines and defense agencies that operate the fleets for the next, 25 years. They're the essential middleman. They specialize in the parts you just can't easily replace.
And that focus, it feeds directly into their revenue structure, which immediately shows you just how profitable these little niches are. So what's the revenue breakdown for FY 2025? What kind of components fall into those categories?
Okay, so they break it down into two main segments, plus this tiny little non-aviation segment we can mostly ignore. The largest is power and control. That accounted for 51.6% of net sales in fiscal year 2025. This segment, it generally covers these highly complex mechanical systems. Think of motion and energy management, things like engines and auxiliary power units, fluid handling components, electromechanical actuators, motors, pumps.
The really critical stuff.
The most critical. And because these parts are so integral to the engine and flight controls, the regulatory hurdles are just astronomical.
And that complexity, I assume, is what drives that insane margin.
Oh, it's absolutely staggering profitability. That power and control segment achieved a 56.9% EBITDA margin. And just to reiterate for you, for a company that is primarily dealing in physical hardware, that number is revolutionary. It's unheard of. Their second segment, airframe, that covers everything related to the structural integrity and function of the fuselage. So specialized fastenings, door components, interiors, safety features like seatbelts, flight deck controls. And this segment was 46.6% of net sales in FY25, and it also generated an industry-leading 53.7% EBITDA margin.
Wow, so roughly 98% of their entire business is in these two segments. And
Yeah.
both of them are operating with like software level profitability. So what's the ultimate long-term goal that underpins this whole structure? It's not about the first sale, is it?
No, not at all. The initial sale, that's the OEM phase. That's just the barrier to entry. It's the cost of getting in the game. The real underlying value driver, the thing that makes the whole model work, is securing proprietary content on new aircraft that guarantees significant long-term aftermarket revenue. This is the key insight. You have to remember the lifespan of an aircraft. 25 to 30 years is pretty standard. So once their proprietary part is integrated, certified, and flown for the first time, they become the essential and often legally mandated sole provider of replacement parts, maintenance kits, and upgrades for the entire lifespan of that global fleet. They're not playing a quarterly game. They're playing a multi-decade cash flow game.
Okay, so let's dive into the results of this strategy because from a pure operational standpoint, they are, well, they're undeniably spectacular. We saw some impressive top and bottom line numbers for FY 2025. How impressive are they really compared to the rest of the aerospace sector?
The execution was incredibly robust, especially when you think about the global supply chain constraints everyone was facing. Net sales for FY 2025 hit $8.831 billion. That's a solid 11.2% increase year over year. But the real story, the leverage they achieved through pricing, that's what matters. Net income hit $2.074 billion. That's a 21% increase over the previous fiscal year.
Wow.
Yeah, that kind of margin expansion, it just demonstrates flawless execution of their core strategy, drive up prices in the aftermarket, and keep a tight lid on costs internally.
And the margin is the ultimate proof. Let's talk about the key metric they use, EBITDA as defined. And for everyone listening, we should be really clear about why they define it that way.
This is absolutely crucial for understanding TDG's health. They reported this operational metric called EBITDA as defined, which was an enormous $4.760 billion in FY25. And that's what gets you to that consolidated margin we talked about, 53.9% of net sales. Industry leading. Now, the reason for the as-defined part is critical because TDG is, at its heart, a private equity operating model. They have these constant high expenses related to perpetual M&A, due diligence fees, integration costs, transaction costs, and this unique management compensation that's tied to their leverage structure.
So TDG uses EBITDA as defined to strip out all those non-recurring acquisition costs and those unique PE-style management fees. It's meant to give you a cleaner, unburdened view of the core operational cash flow from those 115 individual micromonopolies, separate from the corporate M&A engine.
Precisely. It's the metric that shows you the underlying profitability of the business assets themselves. If you look across the entire manufacturing or aerospace sector, this 53.9% margin just dramatically exceeds typical metrics. It confirms the pricing power is, well, it's unmatched.
So with all that cash flow, let's look at what they do with it. This is where that PE identity is just so apparent. It's all about aggressive capital deployment focused entirely on shareholder returns.
Their capital allocation is. It's highly aggressive, and it's laser focused on maximizing returns per share. Acquisitions are the priority, but any cash left over is returned to shareholders in these massive leveraged waves. In FY 2025, they deployed about $6.7 billion in capital in total. The majority of that $5.8 billion went straight back to shareholders. That included about $500 million in regular share buybacks. But the headline event, the big one, was the $90 per share special cash dividend they paid out in September 2025.
A $90 per share special dividend, a single massive payout of over $5 billion. So for our listeners, why does a company do this? Why pay a gargantuan dividend, often funded by new debt, instead of just, letting cash build up or doing regular buybacks?
It's the signature move of a private equity machine. It's a leveraged recapitalization. It's often funded by taking on huge new tranches of secured debt. And what this does is immediately transfer substantial, quantifiable value to the shareholders without forcing them to sell their shares. For the executive team, whose pay is so intensely tied to equity value creation per share, this move provides immediate proof that they are maximizing leveraged returns. It's an immediate, aggressive reward that the market often loves, even with the stress it puts on the balance sheet.
That shareholder focus, though, that's what requires the debt load reality. You can't just pay out billions in special dividends over and over without leveraging the balance sheet to its absolute maximum.
Correct. The other side of that coin is the massive gross debt pile. Analysts often cite it as being around the $30 billion mark. The documented secured debt alone, as of March 2024 pro forma, was $17.18 billion. This debt is the fuel for their engine. It funds the big acquisitions and those enormous special dividends, and it maximizes the leverage return on equity.
And when you look at the basic accounting consequences of that kind of extreme financial engineering, it leads you straight to the negative equity consequence.
Yes. As of September 30, 2025, TDG reported a total stockholders deficit of, wait for it, negative $9,679. So almost $10 billion in negative equity. For your average public company, this would be a flashing red warning light. It would signal severe distress.
And we should probably contextualize that for listeners who might not be Wall Street experts. What does $10 billion in negative equity actually mean?
It means that if you added up all of the company's assets, they would be $10 billion short of covering all of the company's liabilities, what it owes to its creditors and its lenders. The book value of the company's equity is deep underwater. However, and this is the unique context here, this isn't necessarily a sign of failure. It's the planned textbook financial consequence of a highly leveraged PE-style structure. They systematically use debt to fund returns instead of retaining earnings. They're leveraging the reliable future cash flows of their micro-monopolies today to maximize returns. Their debt-to-equity ratio is effectively -5. It's just an aggressive marker of the strategy.
But that leverage, it comes with a real and increasing cost, especially now in a higher interest rate environment. We saw that rising interest rate burden hit them pretty hard in FY25.
That's the anchor they're dragging. Interest expense grew substantially in FY25, hitting $1.572 billion. Just think about that. Over $1.5 billion of their cash flow goes straight out the door just to service their debt. That one line item consumes 17.80% of their total revenue. That is nearly a fifth of every single dollar they earn just going to interest payments.
That percentage is a huge growing drag. And this historical trend suggests that this burden is compounding faster than their own growth engine. I mean, interest expense has accelerated at a pretty problematic compound annual growth rate of 22.24% between 2016 and 2025.
And here's the really problematic comparison. That growth in the cost of their debt has dramatically outpaced their net sales revenue growth. That was only 11.22% CAGR over the same period. So this suggests that while, yes, they are growing quickly, the increasing financial burden of their model is starting to eat into those benefits. If interest rates stay high, refinancing that massive $30 billion debt pile becomes significantly more expensive. And that eats even further into those amazing operating margins and just increases the risk of insolvency if the aftermarket ever hits some turbulence.
Okay, we have spent enough time on the symptom, the massive profits and debt. Let's move to the cause, the structural competitive advantage that allows for those margins in the first place. Let's start with the strategy. It's this simple but frankly ruthless razor and blade model, just adapted for aerospace.
And it's adapted perfectly for this ecosystem. So TransDigm secures positions on new aircraft platforms, the OEM phase, and they often accept very low, thin, or sometimes even negative initial margins. They are not trying to make money selling the first part that goes into a new Boeing jet.
They're just paying the cost of admission.
Exactly. They are locking in the contractual and regulatory right to be the sole supplier of that proprietary component for the aircraft's entire 25 to 30-year life cycle. That long-term right is the gateway to the high-margin proprietary aftermarket revenue, and that accounts for roughly 75% of their total EBITDA. The OEM business gives them the platform, the aftermarket business gives them the fortune.
And once they're locked in and certified, that is when their infamous pricing power kicks in. This is where their controversial value-based pricing model really takes center stage. They explicitly say their pricing is completely detached from the cost to manufacture, which I imagine is often minuscule.
Correct. Their pricing model is derived entirely from the economic value that the part delivers to the customer. And as we discussed, in the aerospace world, that value is calculated by the financial cost you incur if that part fails.
Let's elaborate on that grounded jet example, because it's the fundamental justification for this extreme pricing.
Okay, so if a small, specialized thermal insulation blanket, Maybe it costs $200 in materials and labor to make, if that fails. And TDG is the sole supplier. The airline has to ground its $300 million commercial jet for 16 hours while they wait for a replacement. The financial loss to that airline can easily be in the hundreds of thousands of dollars.
Right.
So TDG prices based on the critical nature of the part and the financial severity of its failure, not on the inputs of labor and materials. It's just pure profit extraction from a captive customer base.
And this model, this extraction model, has made them the poster child of Pentagon price gouging, which is a description that carries a tremendous amount of regulatory risk.
And it's backed by documented scrutiny. The Pentagon's Inspector General, their reviews in 2019 and 2021, they confirmed that immediately after acquiring a company and its IP, TransDigm aggressively raised prices on those sole source parts sold to the Department of Defense.
And the findings, they were just jaw-dropping.
The IG found that TransDigm had booked excessive profit margins that reached as high as 436%. That's over the 15% profit margin that investigators usually deem acceptable for a defense contractor. The government's complaint isn't that TDG made a good profit, it's that they extracted these extreme, non-competitive profits on parts that are essential for national defense.
That number, it needs a specific example to really make it stick. Remind us of the quick disconnect coupling half case.
Right. That's a small part used for fluid lines. It was found to have had a 219% price increase between 1991 and 2017. But even more shockingly, on a subsequent defense purchase in 2018, the Inspector General found that TransDigm booked an excess profit margin of 1,698%. Another stark example, it involved these actuator cover assemblies. They cost TDG about $1,000 to produce, but they were charged to the DoD at close to $13,000. This kind of price extraction has repeatedly put them right in the national regulatory crosshairs.
What's remarkable is just how thin the competitive landscape is for their specific parts. I mean, who is even their primary competition when they operate in these little niche monopolies?
Well, direct competition for their specialized sole source parts is inherently low. That's by design. In the broader aerospace component market, you'd compare them to firms like HEICO and Laura Holdings. Laura is significantly smaller, so they can't really compete on TDG's M&A scale. HEICO is probably the most instructive comparison. They also focus on highly technical, proprietary parts, but their strategic risk profile is just a little different.
Oh, so?
HEICO, they sometimes pursue aftermarket acquisitions where the long-term demand certainty or maybe the IP status is a little bit ambiguous. TransDigm, on the other hand, they maintain this strict discipline. They only target the cleanest assets with the most ironclad monopoly characteristics. You know, parts where they are 100% certain of the long-term aftermarket consumption because of existing FAA or EASA certification. They are just ruthless about the quality of the monopoly they buy.
So if the government is actively auditing and documenting these extreme price hikes, how is TransDigm legally able to keep charging these prices? Especially to the military, which is supposed to be tracking this stuff.
They exploit a crucial regulatory loophole in defense contracting. It's all about cost data disclosure. By law, military contractors are not required to produce detailed cost data, so the breakdown of materials and labor, to help the government determine price fairness for any transaction that falls below a certain monetary threshold. That limit was raised from $750,000 to $2 million back in 2018.
So by keeping their individual contracts under $2 million, they can legally just stonewall the DoD's attempts to negotiate based on their actual manufacturing cost.
Precisely. TransDigm leverages this threshold to simply refuse the government's request for the necessary cost information, and that makes it nearly impossible for the Defense Department to effectively negotiate better deals based on manufacturing costs. They shift the entire conversation to the value of the non-failing part. It's a structural advantage that's built directly into government procurement law, and it's what allows them to maintain this price extraction mechanism.
The ability to execute that aggressive pricing, to exploit those loopholes, it all rests on their structural defense mechanism. You've called it the certification fortress.
This is the ultimate long-term moat. It is more powerful than any patent or traditional IP protection. It's all about regulatory barriers that create these insurmountable economic hurdles for any potential competitor. It essentially kills competition before it can even start.
Let's break down those regulatory hurdles. The FAA, the ESA. Why do they create what you call infinite switching costs for customers?
Okay, so once a proprietary component, let's say it's a specific pump in an engine system, is integrated and certified on an aircraft platform, every single replacement or repair from then on must use a part that meets that exact certification standard. It's required to maintain airworthiness. So for a competitor to come in and develop a generic competing part, they have to not only reverse engineer it, but they also have to submit it to the FAA or ESA for this rigorous, expensive, and really time-consuming testing and recertification process.
And the economics of that certification process, that's what makes trying to enter the market irrational.
Absolutely irrational. If we're talking about a niche component, maybe an advanced cockpit sensor, that only sells, say, 50 to 100 units a year across the entire global fleet.
Okay.
Why would a potential competitor spend $3 million, 2 years of engineering, and significant legal fees just to get certified? The return on investment for that level of sunk cost relative to the tiny annual sales volume, it just guarantees TDG's sole source status. The math itself ensures the moat is perpetual for these parts.
And that structural reality, that leads directly to their dominance numbers. Can you remind us of just how powerful these numbers are?
Well, 90% of their total sales are from proprietary content. They own the design. And critically, roughly 80% of their sales are sole source. This regulatory lock-in legally binds their customer base for decades, and it perfectly sustains those massive margins that, as the investigators documented, can exceed 1,000% on certain parts.
And how do they keep feeding this certification fortress?
Hmm.
Through a relentless, disciplined M&A policy. They aren't relying on internal R&D, they're just buying certified proprietary content.
Their M&A policy is highly, highly targeted. They maintain a strict goal of spending between $1 and $2 billion annually on acquisitions. And they're not just buying any manufacturing business, they are buying pre-vetted, highly disciplined commercial aerospace component businesses that already have the certified IP and, crucially, significant aftermarket content. They buy micro-monopolies with proven cash flow.
And once they acquire these businesses, they immediately implement their internal system to extract the maximum value. We should detail that immediate application of the three-part value-based operating strategy when they integrate a new company.
Right. It's the engine that converts an acquisition into leveraged cash flow. First, they drive profitable new business. They streamline the acquired company's sales efforts toward their high-margin channels. Second, they focus heavily on productivity and cost improvements. They ruthlessly strip out any inefficient corporate overhead or operational bureaucracy. It's the classic PE playbook for cost control. And third, they apply their infamous value-based pricing model across the entire newly acquired proprietary portfolio. This aggressive process is proven to quickly integrate the assets, boost margins, and juice the EBITDA within the first year of ownership.
So what advantage does this constant M&A provide, beyond just getting bigger?
It provides two critical things for a public company that's addicted to growth metrics. First, acquisitions provide immediate access to proven proprietary content and instant cash flow, all driven by recurring aftermarket consumption. They get to bypass the long, risky R&D cycle completely. Second, this consistent deployment of capital, that $1 to $2 billion annual target, it ensures robust inorganic growth. And that is essential to meet market expectations and keep the share price up. Even if organic growth in the existing fleet slows down, they're effectively buying their growth targets.
And finally, let's look at the organizational structure that supports this whole acquisition strategy. This, constellation of over 50 operating units, 115 business units, 16,000 people. It's all managed with a famously decentralized model.
That decentralized model is absolutely key to their success and their pricing agility. Corporate management, the top executive team, they focus almost solely on capital allocation, so the debt and M&A, and incentive alignment, the aggressive performance pay. They are the central financial command.
And they leave the individual businesses to handle the actual operations and the pricing.
Exactly. They leave the subsidiary operating units, which all have their own presidents and managers, to run autonomously. This structure does two vital things. It minimizes the bureaucratic drag that stifles performance in big aerospace companies. And crucially, it allows the local subsidiaries to set their own aggressive, value-based pricing and to negotiate directly with customers without the oversight of some centralized pricing department that might, impose ethical limits or fear regulatory backlash. It fosters this entrepreneurial, profit-maximizing, price-aggressive culture right at the business unit level.
Okay, we've seen the spectacular profit and the nearly perfect competitive moat. Now we have to shift gears and come back to the high-stakes risks that offset this whole compounding machine. If the TDG machine is a financial race car, it's being driven at maximum speed while heavily leveraged. So first, let's revisit that $30 billion debt sort.
The sheer magnitude of the gross debt pile, combined with their reliance on special dividends and leveraged buyouts that drive that negative equity position, that represents the critical financial risk. The company has virtually zero buffer.
And how does that debt impact them in a stressed environment? If the aerospace market faces a sudden downturn, or if interest rates keep climbing, what's the consequence?
The inability to service that debt could be catastrophic. This level of leverage leaves minimal room for error in their cash flow projections. A severe downturn could force immediate distressed asset sales or refinancing under extremely onerous terms, where the new debt costs consume even more than the current, 17.8% of revenue. The leverage that amplifies returns when things are perfect becomes the single biggest anchor when market conditions get worse. That negative equity position, that $10 billion hole, it just confirms how little shareholder capital is actually insulating the company from its creditors.
The rising interest burden is the ongoing, quantifiable cost of that risk. But the other major risk is the regulatory backlash we've detailed. We're talking about tangible consequences here.
Yes, the history of DoD audits proves the risk is real and it's quantifiable. The sources confirm a history of them finding excessive profits, which led directly to a mandated $16.1 million refund to the government back in 2019. This demonstrates that political scrutiny does have the power to limit future profit extraction and force repayments.
Which suggests a quantifiable risk. If the government decides to tighten that cost disclosure threshold or mandate audits on all sole source suppliers, the core TDG price extraction model faces a direct existential threat.
Absolutely. The ultimate legislative hammer is always just hovering over them. If Congress decides that their current pricing model for defense parts is politically unsupportable, they could pass legislation to change the rules of the game. They could mandate cost disclosure or cap margins on sole source components, and that would directly erode the core margin advantage that supports their entire valuation and their debt structure.
And beyond just the pricing scrutiny, there are other serious legal exposures tied to this aggressive culture: the compliance and legal exposure. The sources mention concerns that TransDigm broke disclosure rules.
Yes. They faced allegations that they failed to report the ownership of 12 subsidiaries that were bidding for Pentagon contracts. For the military, transparency is essential to make sure they aren't paying wildly different prices for the exact same part across different suppliers. So by allegedly failing to report subsidiary ownership, they make it harder for the government to track systematic price hikes and potential price gouging. It just further insulates their aggressive pricing strategies.
And even more concerning are the allegations of financial fraud from former employees. It suggests that this intense pressure to hit targets might be pushing people beyond legal boundaries.
The allegation from a former finance chief of a subsidiary, Abt Hektai, that's a significant red flag about the internal culture. He claimed he was pressured to commit financial fraud, specifically through this practice of premature shipping to book milestone payments and hit internal booking deadlines. He cited a specific case where a part was allegedly shipped to Lockheed prematurely twice, just to meet booking deadlines, even though the part wasn't ready. Now, we have to stress these are allegations, but they do raise serious questions about the ethical tolerances that are being fostered by that performance-driven incentive structure.
Let's talk about that incentive system again, because it feels like the root cause of both the success and the risks we're detailing. It's what links the $30 billion in debt to these alleged fraud claims.
The system is extreme. It's built to ensure managers act like owners and maximize returns for shareholders immediately. For senior executives, 80 to 90% of their total compensation is performance-based. It's tied aggressively to metrics like equity value creation per share. The goal is long-term stock appreciation, fueled by aggressive operational metrics like annual operational performance per diluted share.
This structure, it undeniably incentivizes that aggressive, debt-fueled shareholder return model and maximizing pricing power.
It does, but it also inherently incentivizes the aggressive pursuit of revenue and price hikes that fuel the regulatory issues and potentially the extreme internal pressures that lead to these allegations of misconduct. It is a compensation system that puts rocket fuel in the tank, but it seems to ignore the warning lights.
Finally, we need to touch on the leadership transition. In October 2025, Mike Lisman succeeded Kevin Stein as CEO. Does this signal any kind of shift in their model?
Lisman's background is a clear signal of continuity. He was the CFO, the co-COO, and the VP of M&A. He is deeply familiar with, and frankly an architect of, the financial engineering that defines TransDigm. His expertise is in capital allocation and acquisition strategy.
So the appointment really just confirms that the existing, highly leveraged, acquisition-focused model is expected to continue full steam ahead.
Exactly. There is no indication whatsoever that the company intends to pivot away from its debt-fueled M&A model or its aggressive approach to pricing. The risk is that the structure that worked perfectly for 30 years is now locked in under a CEO who has everything. The regulatory spotlight just gets brighter and brighter.
Okay, let's synthesize the final investment case for our listener. TransDigm is, without a doubt, a compounding machine. Its superior long-term stock performance, that 27% 10-year CAGR, that speaks for itself. The moat, built on proprietary certified parts and those high barriers to entry, it's near perfect. But here's the problem, that success is fully baked into the valuation. If you look at the 39.8x PE ratio, the market is pricing this company for absolute perfection. There is zero room for error.
We have to weigh two things against each other, the compounding monopoly thesis and the extreme financial engineering risk. Does that long-term, recurring aftermarket revenue, backed by high barriers to entry and an aging global fleet that needs more parts, does that fundamentally justify the massive debt load and the rising interest expense, which, again, consume nearly 18% of revenue in FY25? That debt load, which has negative equity as a consequence, is a risk that most other comparable quality companies just do not bear.
The ultimate conflict is the regulatory crossroads. It's this constant tension between TDG's highly effective price extraction strategy, their genius in maximizing value-based pricing, and the resulting public and government backlash. The question isn't whether they can price parts at 4,000% markups today, but whether they will be allowed to tomorrow if regulators decide to cap margins or change those disclosure rules.
And if that pricing power gets capped, the growth trajectory slows dramatically. And when the growth slows, that immense debt load, which was designed to amplify returns during rapid growth, it becomes a much more serious anchor on equity value creation. The question for the careful investor is whether this company, priced for perfection, is really a value trap in reverse, where the single risk of legislative intervention could just negate decades of structural advantage.
What stands out to me is what Charlie Munger said. The pricing strategy is too brutal. It attracts unwanted attention. But let's look at the counterargument again, because it's the core of their defense. Their structural business advantage is that it is economically irrational for competitors to challenge 80% of their sole source parts because of the certification costs.
That is the ultimate defense. They rely on the fact that economics, aided by regulation, dictates that competition will simply not appear.
So here is the ultimate provocative thought for you to mull over. The government can mandate a $16 million refund, and they can voice outrage. But can the government force a competitor to spend millions to certify a specialized part that only sells 100 units a year? Does the structural near-perfect economic fortress of the business ultimately supersede any political or regulatory attempt to limit their pricing power? Risk defined, portfolio protected.